Well, good afternoon, everybody. We've still got a few people in the waiting room. We're just letting in. So once everybody's in, we will make a start. Just give us a couple of minutes. Okay, we'll keep letting people in as they arrive, but good afternoon and welcome to, I think, the 10th CEA Power Hour. I'm Joanna Oliver. I look after the international programme for the CEA, and that's not happening much at the moment, so I'm also running our External Affairs and Government Liaison Department. Quickly run through the rules of the CEA House. The webinar is held in accordance with the CEA corporate compliance rules. That's really important that we don't discuss anything which would violate them. The webinar is being recorded. I noticed that I got a verbal warning now to say it was being recorded, and if I didn't like it, I could go away. So hopefully you all got that. Please do stay on mute unless you're asking a question, so we don't get to share your lunch with you. If you'd like to ask some questions, and I'm sure you will, because last time Chris spoke to us about 6 months ago, we had loads of questions. So please do write your question into the chat box, and then either Chris or I will raise it at the end of Chris's presentation. To conserve bandwidth, please do turn off your video, and then hopefully we won't have any technical issues. But if we do, we're doing our best to rectify them. So please don't blame us, and we won't blame you. So today's menu, we're really pleased to have Chris Slight back again today from Off-Highway Research. And I've known Chris, gosh, must be 25 years since we were all a lot younger and less grey. Last time I saw Chris was after ConExpo last year. We were having dinner in a rooftop restaurant in Las Vegas. The news came through that the first COVID case had been diagnosed in Vegas in Chris's hotel. So there was a quick exit of off-highway people, and that was the last I saw of Chris. Chris is recognised as one of the world's leading authorities on the global construction equipment market, and he holds an honours degree in civil engineering. Since joining KHL in 1997, he's edited 2 of the leading magazines for the construction equipment industry, which was International Construction and Construction Europe. In 2015, Chris decided to be a poacher turned gamekeeper, and following the acquisition of Off-Highway Research by the KHL Group, Chris transferred to market intelligence, forecasting and management consultancy business. He took over as managing director of the business unit in 2018 and is responsible for all aspects of the day-to-day running of the division. Off-Highway's latest reports include a study on the global rental industry and a detailed analysis of the impacts of Brexit on the UK construction equipment industry. So let's go forwards. So I'm now going to stop sharing my screen and hand over to Chris, who will start his presentation very shortly.
Great, thank you very much, Joanna. Are you hearing me okay and seeing the opening slide?
Yeah. Excellent.
All right, well, great. Well, thank you very much for the introduction, Joanna, and thank you for having me again. As the intro said, I'm going to run through in some detail actually about what we're seeing in the global construction equipment markets, and and hopefully there will be questions, and I'd certainly welcome anything that you have at the end. As Joanna said, type into the chat channel and we'll get to as many as we can. So many of you will be familiar with off-highway research, and the introduction covered it to some extent. The business is in its 40th year now, having started life as part of the Economist Intelligence Unit, and is now owned by KHL Group. Our offices are strategically located in some of the key equipment production countries around the world. And in addition to off-highway research's own staff, we obviously have access to a much wider network through KHL. In this presentation, I'm going to be talking about the market. Now, everybody will measure the market in different ways and include different things, but just for the sake of some clarity, these are the types of construction equipment that are going to be included in the discussion. So the absolute numbers that I say may differ from anything that you may look at in your companies, but hopefully I would certainly expect that the trends would be the same and the drivers would be the same. So what are the headlines? The global market, as we all know, it is a cyclical market. And the sort of the recent history was an upswing in the second half of the 2010s, with global demand reaching a peak in 2018 and 2019. And that peak was in fact a record, about 1.1 million units sold in each of those years, with a retail value of about 110 billion US dollars. At the end of 2019, we felt that peak had passed, and there were some very clear signs of that. And we were expecting a downturn in 2020, albeit quite a soft landing. I think the conditions were still generally good. Infrastructure construction was generally good around the world. So we were expecting a slightly soft landing. Of course, COVID came along and that changed things, but possibly not in the way you would think. The Chinese government was so quick out of the blocks with its stimulus that the volume of equipment sold last year was actually more or less equivalent to what happened in 2019. So global sales in a COVID world were actually higher than we were expecting before anyone had heard of COVID. So a very, very unexpected result there. The follow-on from that is, obviously most markets around the world are bouncing back now. And again, we'll go into that in some detail. And that buoyancy is continuing in China. So we actually think it's fairly likely that in global terms, there'll be a record volume of construction equipment sold this year. So let me just unpack that a bit for you. This line graph kind of shows where we were historically in terms of unit sales. That's the red line. And the grey line was the forecast that we had in late 2019. As I said, softish landing, fairly good volumes, but a downturn nonetheless. What actually happens and what we see going forward is represented by this orange line. So there in 2020, you can see next to no decline. And then moving ahead to this year, we do see an uptick, which would probably edge us into record territory. As I said in the previous slide, that was all about China. So just looking at China, again, this is the same sort of thing. Historic sales in red. Certainly in 2019, the market was showing very clear signs of falling, and we were expecting it to drop off for the next couple of years. What actually happened was a 30% increase last year, and actually most of that was after the first quarter. So enormous volume sold in the final 9 months of the year. And again, that buoyancy is enduring and will probably take the market to a record level this year. So, as we saw in 2010 and 2011, very, very strong, very, very sort of quick stimulus. And that's driven the market up very quickly and very steeply. So if you take China out of the equation, this is kind of what the rest of the world looks like. As I said, the grey line, we were expecting fairly soft landing. The actual decline we saw in the world, excluding China last year, was about 12%. And then a sort of a gentle rebound this year, more or less getting the market back to where we thought it would be. I would make a couple of points on this graph. First of all, in general, in a market like this, you know, a 12% annual decline is not actually that out of the ordinary. It's a slightly steeper magnitude than you would perhaps normally get or would like, but it's, you know, it's clearly not as bad as we saw in the financial crisis years. Much shorter and much less severe decline. I think the other point I would make is the volumes that the market fell to in 2020 were actually still decent. You know, you're going back to the kind of levels that were seen in 2017. So, you know, actually fairly strong. As I said, nothing like the impact we saw in the financial crisis, and stronger volumes than we saw in the aftermath of that in the early 2010s, where you kind of had this period of really, you know, no growth, a fairly anemic picture. So, I mean, I think the takeaway from this is that the impact of COVID is certainly not as bad as it could have been, and not as bad as we feared maybe 12 months ago, when people were sort of anticipating, I should say we were as well at Off-Highway Research, maybe a 20 to 30% decline. So I think it in terms of this industry, the impact of the pandemic has been a lot milder than it could have been. Just to zoom in a little bit closer, what I have here is some aggregated financial results for the 20 or so major international OEMs that are stock market listed. So this would be the major US groups like Caterpillar and John Deere. In the case of John Deere and some of the other companies that are kind of conglomerates, we've only pulled out the construction equipment sales, so it doesn't include ag equipment, which applies to a few of these manufacturers. Then you have the major Japanese groups like Hitachi, Komatsu, some of the compact equipment specialists, and of course the European groups like Volvo, Wacker Neuson, and some of the specialists like Manitou. So when you find all the companies you get about 20 international OEMs, and this chart shows what's happened on a quarter by quarter basis in terms of their revenues as represented by the red column, and their operating margin as represented by this orange line. So the first point is, if you go back to the fourth quarter of 2019, you know, this cyclical downturn that we were expecting was clearly apparent. Normally the fourth quarter is a bit better than the third, but it ticked down then. And that kind of reinforced the view that we had prior to COVID, that the market was cooling. And then, of course, when COVID struck the Western world in Q1, but mostly in Q2, you saw this very sharp decline in revenues and an accompanying fall in margins. The good news really started in the second half of the year. You saw a pronounced rebound in revenues first, and you know, more recently, I think, particularly in the last quarter that's just been reported on, we've seen an improvement in margins, and margins are up to sort of 12%. So again, this kind of reaffirms the view that the markets, excluding China, and really when you're talking about this group of international OEMs, that's what you're talking about, their sales in China are not actually that significant. So that shows that this rebound is really happening, and that it is quite strong and quite pronounced. The bringing in some Chinese OEM financials. A lot of these groups are publicly listed, and they don't report quite as promptly as the US, Japanese and European groups. So we don't have a clear picture of Q1 yet. But if you look at the previous quarters, so here in this chart, I've got the international OEMs revenues in red, as what I've just shown you, and some of the major Chinese OEMs shown in grey. So that would include the sort of Chinese household names of Sany, Zoomlion, XCMG, and Zoomlion, and one or two other smaller ones such as Shaigong and a couple of others that are of interest. So this, I think, again, this kind of illustrates the sort of the strength of the upswing that we've seen in China. You saw that really in the second quarter. So I said at the start, stimulus in China started in April, and you went from obviously a COVID impacted first quarter in China to revenues actually doubling. And that sort of strength has continued. The margins in China are actually quite strong. You know, we often kind of sneer a little bit at the commercial practices and some of the things that go on of these OEMs chasing volumes rather than profitability. But the margins are as strong, if not better, than what we're seeing for the international OEMs. In the fourth quarter last year, it was a sort of a 16% margin across the Chinese industry. So, you know, very, very strong. And the other thing I think to pick out is when you take this sort of sum of the OEMs in the international sphere and in China, if you look at the fourth quarter here, that is the best fourth quarter on record. It's higher than the 2018 fourth quarter, which was the previous record. So I mean, with the way things are going, the continuing buoyancy in China and what we're seeing internationally, I think that really does reaffirm the likelihood that we're going to see a record year this year. Of course, it's early days and things can change, but at the moment, that's the way all the evidence is pointing. So for the second part of this presentation, I'm just going to take a sweep around some of the major territories, obviously the ones where we have offices. But I would add that if you have questions at the end about other parts of the world, I will try to answer them. Not promising to answer them well, but I will try. So yes, the story in China is just about stimulus spending, and you see it here in this graph, which is kind of a rerun of what we showed before. We expect a little more growth here, and the figures here not only include the earth-moving equipment, but compaction equipment and mobile cranes. So we would expect volumes to pretty much touch 500,000 in China this year. If you think that the global market is about 1.1 million machines, it really does emphasize how enormous demand is in China right at this moment. I think the obvious question is that, okay, last time we saw volumes like this were 2010 and 2011, and the following 5 years were absolutely horrible in China. Construction work kind of fell away, but there was still this volume of young machines in the market with not much work to do. So that was a huge barrier to new equipment sales. And so you had a pretty miserable 5 years until right at the end of 2016, when the One Belt, One Road project started to come through and equipment sales picked up. Of course, the market will come down from this peak, and we're expecting that next year, but we're not forecasting the same sort of crash. Couple of reasons for that. First of all, although the volumes are comparable, the structure is different. There are a lot of compact machines being sold at the moment. And I think this is illustrated here when you look at the composition of the market. Mini excavators have become absolutely massive in China. About 100,000 mini excavators will be sold this year. China's by far the largest mini excavator market in the world. And we feel that is a permanent structural change in the market. It's a function of labour prices rising, so mini excavators are more economical, as well as rising wages for manual workers. The price of a mini excavator has more or less halved in the last 5 years as the volumes have kind of crept up and so many more indigenous manufacturers have joined the fray. So mini excavators really compete on an economic basis. And that has also kind of allowed them to find new markets. They're being used in smaller scale construction in rural areas in central and western China more and more, and also being used in agriculture to some extent. So we think that structural change is here to stay because of the underlying economics. I think the other thing to say about China as well is that in the previous boom 10 years ago, a lot of it was about new build, to a certain extent roads, but there was an enormous lot of high-speed rail construction done in China. China is still a big new build civil engineering market, of course, but a lot of the market has now moved on to sort of a repair and maintenance type activity. And that provides a sort of a steadier workload and more predictable sales for the construction equipment world. So yes, the market will decline, but we feel that the economic drivers and the changes which have taken place mean it will decline to still kind of manageable levels rather than painful levels. production and sales in China. So in this graph, for any given year, you're seeing production in the red column and sales in domestic sales in the grey. So historically, in the 90s and 2000s, not a lot of production or sales, and it was more or less in balance. Particularly in the last decade, you've seen production move ahead of sales, which is indicative of China establishing itself as a kind of a global production hub. That's not just the indigenous Chinese OEMs, which of course have ambitions to be truly global. Many of the international OEMs also have significant manufacturing in China, and they're tending to use that to serve international markets, particularly emerging economies. And you can understand the reasons for that. You know, you're talking about machines of a similar spec to what's made in China and what is required in emerging markets. There's obviously enormous scale in China, and you know, maybe a bit of a price advantage in labour cost, although obviously in our industry that's not a huge thing. But yeah, China is certainly developing as a hub. So just to sum up China, it's been all about stimulus and the infrastructure programs. There is a little bit of environmental regulation at play. We've got the China 4 regulations coming in, and in certain cities in China, they are sort of mandating the best, lowest emission machines available on the market are used. And actually, it looks like Beijing will try and sort of effectively unilaterally bring forward China 4 by about a year and require those machines to be used. So obviously that does kind of drive fleet renewal, and you can understand the reasons why. If you've been to China, you'll know firsthand how horrible the air quality can be in some of these big cities. Sales are still growing as we sit here and speak now. Things can change fairly quickly in China, and we obviously keep a close eye on that. But at the moment, you know, the signs are still strong, and as I said, structurally, we feel there are reasons to think that sales will remain strong. There are a few issues. As I said, the big Chinese OEMs are earning decent margins at the moment, but there is a tendency in China for these companies to kind of chase volumes and market share. Things are actually very much geared that way. It's the way sales forces are incentivized. They're incentivized on market share. And that does, of course, lead to price competition. As I mentioned, the prices of mini excavators have fallen very, very sharply in the last 5 years. You know, we feel that quite a lot of those machines will probably be being sold at a loss right now. So we kind of wait a little bit with bated breath to see what happens when demand falls away, to see if kind of damage has been done with some of these actions. And yes, you know, there is a question whether the market has overheated. It has got very high and it will correct, but as I say, at the moment, we don't feel there's a need to worry about a crash. And exports, notwithstanding the huge demand in China last year, the country also managed record exports of about 82,000 units, 14% of its production. As I said, that is also the international OEMs making use of their factories there. You know, I think the big question for China, the philosophical one, is really how successful Chinese OEMs can be on the world stage. They obviously have success in other emerging markets. The holy grail for many of these companies is, of course, to also carve out significant market share in Europe and North America. You know, they are chipping away at that, and one or two are having success. But, you know, it does remain to be seen. I think to do it organically takes a long time and a lot of investment. So it does raise the question about whether some of these big groups, especially now that they're flush with money, will look to make acquisitions to accelerate those ambitions. Looking now at India, India is obviously in a very dark place in terms of what's happening with COVID at the moment, and we're still sort of, you know, thoughts and prayers are with the country. It's very close to home, having staff there. So we're still kind of processing what's going on and still trying to understand what it means. In terms of what's happened in the market, in 2018 there was a general election, which is always a very disruptive event in Indian commerce, and the markets do fall as a result. One of the reasons is that as soon as an election is announced, there's a moratorium on awarding public works contracts, because they can be seen as a way of buying votes. So that's very disruptive. Then the new government's elected, takes a while to form a government, and then the monsoon comes. So it's all a very difficult thing to cope with. The market was picking up towards the end of 2019. Certainly felt that at the XCon show that year in December. But then, of course, COVID had a very big impact, and the market fell again. So the forecast that you're seeing here was made prior to the recent spike in COVID infections in India. So it does remain to be seen what happens this year, whether there will be a rebound or whether things will kind of suffer again or stay flat. We just don't know at this stage. It's obviously an evolving situation. I think the point I would make about India, however, is that the fundamentals for a strong equipment market are there. It is a country that's investing in its infrastructure, particularly in roads, but increasingly it's going out to rail. It's Prime Minister Modi has got quite a lot of ambitions in developing a high-speed rail network, and that's obviously very significant for construction equipment. But in India, it's everything that's infrastructure is required, be it water, sanitation, affordable housing, airports, you name it. And the money is being invested. So, fundamentally long term, we see growth happening in India over the medium term and off into the future, notwithstanding the fact that general elections muck it up every 5 years. We just kind of hope that it comes through the current difficulties as quickly and as unscathed as it can do. The market structure in India is odd. It has to be said. Backhoe loaders are hugely popular, and JCB is by far the clear market leader in India. It really is a remarkable market. In the boom years, you'll get in excess of 40,000 backhoe loaders sold in India. The Indian market for backhoe loaders is bigger than the rest of the world combined. Notwithstanding that, those machines will always be popular. They're important entry-level products, and they're certainly important in rural settings. But we do see a bit of a swing towards crawler excavators as the market kind of gets a little bit more mature and moves on to a bigger and more productive equipment type. So it's kind of a slow burn, but that's the way things are going. As I said, most of the infrastructure work to date has been in road building, so there's a big market for pavers and compactors, and the presence of lots of backhoe loaders means the wheeled loader market is quite small. The mobile crane market in India is also, while it's big, it's also quite odd because it's dominated by domestically made pick and carry cranes, and so not really sort of traditional lifting equipment that we would see in well, anywhere else in the world, really. The other thing to note is there is an emergent compact equipment market for mini excavators and skid steer loaders. It's very small, and it probably will be for some time, but there is growth there. Again, you're talking about machines that are competing with manual labour, and of course there's a lot of that available in India, but this market basically didn't exist at all 10 years ago, and now it's a couple of thousand machines a year. So it is coming, and it will continue to, but it will be a very slow burn. And again, looking at the sort of the balance of trade dynamics, historically back in the 2000s and beyond, India was very much a sort of a self-contained market. The machines that were made there were sold there predominantly. There was a little bit of import for equipment that was needed, but which wasn't made in India. If you move on to the 2010s, you've kind of seen that flip round, and production has moved ahead of sales as the sort of the manufacturing footprints that have been built up in India have been used to start to serve neighbouring markets, not just sort of the greater India area of sort of Bangladesh, Sri Lanka kind of places, but also the Middle East and parts of East Africa and the sort of Indian Ocean rim. So we kind of see that continuing. There is obviously reasonable scale in India these days, and it makes sense to use those factories in that way. But, you know, I can't really see India racing ahead to sort of be the next China and having a huge proportion of its production exported. But, you know, it's definitely swung, and we think that's here to stay. So in summary, yes, you know, the market has been very, very badly disrupted. Again, you know, last year wasn't as bad as it might have been, but I think, as I said, as we're all aware, the COVID story has not really played out in India yet. So we do watch and wait. Yeah, the long term, it does look promising in India, but India kind of needs to come through COVID before that market picks up. Looking now a little bit closer to home and looking at Europe, yes, you know, the market is clearly rebounding. What we've seen historically is a similar picture to other parts of the world. Things reached a peak in 2019. We were expecting a correction in 2020, but obviously with COVID, that was much steeper than was expected, about a 16% decline. And what we see over the medium term in our forecast is a fairly modest rebound in growth terms. But again, and you see this in a lot of markets around the world, you know, the volumes in Europe, even last year, were actually reasonable. Around about 150, 160,000 units is a pretty good volume in Europe. And one of the reasons there isn't potential for an enormous rebound is that the markets have been good for a couple of years. So there are populations of machines there, and, you know, in some cases, you might even describe them as being saturated. So quite a modest rebound in Europe is coming, but I think overall, and taking an objective view, you have to say that volumes are pretty good. The difficulty, as always, talking about Europe is it doesn't make a lot of sense to talk about the headline figure because you're talking about a lot of quite disparate countries. So what I've tried to show here is what happened in 2020 in terms of, in every case, a decline, and then what we're forecasting for this year. Italy stands out. Italy is different to the other European countries in that most of the other countries had reached a peak in 2019 and were headed for a downturn anyway. Italy was a couple of years behind that cycle and still had several years of growth to come. So even though it was affected early on and very severely by COVID last year, as it turned out, the market essentially didn't fall at all, had a very strong fourth quarter. And then we expect this growth trajectory to resume this year with some fairly strident growth. So yeah, Italy is kind of a different one. Switzerland as well to some extent, although obviously it's a much smaller market. And then as you kind of look down the page, you obviously get to the greater and greater impacts. The European average decline was about 16%. So you could say any country from Austria upwards had a relatively mild decline. And obviously Germany is very significant in that, being the largest market in Europe. And then below that, you see the countries which are have been more severely affected, and that includes France as another big market. And of course, some of the, as you see at the bottom, some of the worst impacts have been in the UK and Ireland. Now, while it is true to say that the countries with the biggest downturn last year tend to also sort of be due the biggest rebound this year, it's not really the case that these balance out. So the countries at the bottom of this chart would tend to be the ones that sort of have the most profound medium-term impacts from the COVID pandemic. So yes, there will be some interesting growth this year, but volumes will take a little bit longer to recover. The only one I would also single out here is Germany, which, having declined last year, is actually heading for a decline again this year. The situation in Germany is the market went to absolutely staggering highs in 2019. the volume of equipment sold last year actually exceeded what was seen in the boom years following reunification in the early 1990s. So Germany is one of these markets that we feel is probably saturated. So it doesn't have much potential for growth, but the volumes there are still very, very good on a historic basis. So, you know, again, it just kind of goes to show that just looking at growth probably doesn't tell the full story. If you look at volumes in countries like Germany, the situation is actually not too bad. The composition of the market in Europe, looking over quite a long timescale, has changed. Back in the 1990s and previously, there were traditional products that sold in quite high numbers, such as backhoe loaders and, to a lesser extent, skid steer loaders. What we've seen, and what I think we'll continue to see, is really those products diminishing, and they've been replaced by mini excavators as the digging tool, and telescopic handlers and compact wheel loaders as kind of the front shovel tool. And that means that the market is really sort of gravitating towards this sort of situation where excavators, be they mini, crawler or wheeled, a very high volume, wheel loaders and telescopic handlers alongside them. Those few equipment types make up about 90 to 95% of demand. The others, you know, again, there are niche products. Some of them are significant because they're big ticket items, things like dump trucks and dozers. But in terms of the mass market, you're talking about these more obvious machines. And just a word on the sort of the net import-export situation in Europe. Historically, Europe, particularly in the 2000s, was a net exporter. It tended to serve markets in Africa and the Middle East from its European factories. And over the 2010s, we've seen that diminish. There have obviously been quite a few factory closures, and there are a few more announced and planned in Europe. And that's really happened for two reasons. One is that emerging market business is now served from China and to a lesser extent India. And also I think it's sort of become clear that this model of sort of satellite factories around the world is not necessarily the most economical for some OEMs, and that they kind of see a benefit in just having one enormous mother plant, often in their home country, which really kind of provides the scale. And the idea of having a, you know, even if it's quite a substantial factory in Europe, has kind of fallen by the wayside. So yeah, unfortunately, Europe has become less competitive as a manufacturing hub for those reasons, and will probably be a net importer in years to come. So just to summarize, yeah, the decline of 16% was not great, but not as bad as it could have been. The volumes are still good, and that will continue with a bit of a rebound this year. Not wishing to go down the rabbit hole of Brexit, but obviously there is greater concern in the UK and Ireland because of the very severe impacts that we saw last year from COVID-19 and whatever damage Brexit does to those economies. I think because there's a lot of government support in place at the moment to protect jobs and to keep businesses going, you know, we really haven't seen what the genuine impact of those two issues is. I think we wait and see. I think the positive is that whatever you think about the government, it does kind of seem a government that's keen on infrastructure. So we would hope for a certain amount of stimulus to come in the years to come, but clearly two very big negatives that have the potential to weigh on the market for some time. Turning now to North America, we expect the recovery to be very robust. If you look at this graph here, the downturn last year was about 8%, we feel, and then we see the market shooting off to the stars in years to come. Now, before anyone gets carried away about that, I'm going to have to unpick that and just kind of emphasize what's happening in terms of the individual equipment types. So what you're seeing in America in terms of composition, there has been a lot of change over this sort of 20, 30-year timescale. Back in the 90s and previously, the traditional smaller products were things like skid steer loaders and backhoe loaders. And then in the 90s, 2000s and 2010s, you saw a big uptake for mini excavators and latterly compact track loaders. There's not a lot of difference between a compact track loader and a skid steer loader in how they look. They basically look like the same machine, except one is on wheels and one is on tracks. So clearly what's happened is as these compact track loaders have come on the market and gained acceptance, they've kind of replaced skid steer loaders. Despite being more expensive to buy and to operate and maintain, they have an advantage of much lower bearing pressure, so you can use them on dodgy terrains, or you can use them on ground without as many concerns about damaging the ground. So they've become very, very popular, not only displacing skid steer loaders, but also kind of finding new applications because they have that rough terrain capability. And at the same time, backhoe loaders, sales have diminished. They're still important, but not as much as they were. And again, clearly it's the mini excavators that have made the difference there. And you've also seen a bit of an uptake in telescopic handlers. So the market structure has changed significantly. And a lot of the growth that's happened in North America and that we see happening in the years to come is in this sort of compact equipment area. I'll just kind of attempt to illustrate that. So sort of presenting those figures in a slightly different way, if you break it down into compact machines up to about 6 tons, what you might call midi machines from 6 to 10 tons, and then large of 10 tons above, I think this kind of really illustrates how the compact machines really influence what's happening in volume in unit terms. In 2020, sales of those compact machines actually went up. That was because the residential market was strong. Residential construction is really the driver for this type of equipment. And that was not only because housing starts were quite good, but also because there was a lot of repair and maintenance work, you know, as there was in this country and around Europe. As people had to work from home, they suddenly sort of started improving their properties, extending them and putting offices in their gardens, and that demands equipment. So moving forward, we do see the compact and MIDI sector really being the driver of that growth in terms of unit sales. Last year, the sales of large equipment did dip quite spectacularly, really, but they will bounce back, particularly if there's really good stimulus investment in North America, which we expect there will be. But that volume, you know, is actually much steadier year to year than the compact equipment volume. So yeah, I think hopefully that explains why we see these volumes getting very high. But if you look at it from the point of view of the value of the equipment, you know, the growth is less pronounced, and it also illustrates the point that you can sell all the compact equipment you like. It doesn't make an enormous difference to the value of the market. The thing that really makes a difference is obviously the heavier equipment. So while the downturn in volume terms last year was not that great at only 8%, it was obviously very big in value terms, and it will take a couple of years for that to rebuild. But notwithstanding that, you know, it should, as long as the stimulus happens, it should fairly quickly get to, you know, good, if not record values. North America production sales, again, I think North America looks like now what Europe could become. It's been a net importer for some time. The main reason for that historically has been mini excavators. There aren't many people who make mini excavators in North America. Historically, it's been Bobcat, of course, and Caterpillar more recently. But most mini excavators which are sold in North America are made in Japan. In addition to that, the compact track loaders, although that is a very American product and the majority are made in North America, first of all, there isn't much of an export market for that type of equipment. Their popularity is largely limited to North America, although they're popular in Southern Europe as well. In addition to all that North American manufacture, which is mostly sold in the region, you do have a couple of Japanese manufacturers now manufacturing in significant numbers. So that has kind of tipped the balance even further towards net imports for North America. So in summary, certainly the downturn wasn't as bad as it could have been, and the volumes were good. Compact track loaders have been a very interesting sort of product introduction in the North American market, and they have made a big difference, and I think have genuinely grown the market for construction equipment. Yeah, going forwards, a buoyant residential market will be good for those compact machines, but I think stimulus spending is really what everyone's looking for in North America, and that will obviously be good for the larger equipment. So wrapping all that up, and just to take a look at the global outlook, this year will be strong. Absolutely, clearly, everything points to that. I think the question that we really have to ask about the industry is how well it can supply that demand. We're seeing a lot of issues around that, with supply chains being stretched, lead times getting longer, and I'll go into that in a bit more detail. Beyond this year, I mean, really, I think what matters is the policy response as the world kind of comes out of COVID. In addition to that, some of the things that have changed in society because of COVID, I think, will stick, and they will have an impact. And the other thing which I'd like to explore a little bit is that because the peak in equipment sales has been very much prolonged, we'll end up with quite a high population of young machines in the market, and that can be problematic. So first of all, the forecast, which I've attempted to highlight here and split out by the regions. And the general point here is, going forward, sales in China will diminish from next year onwards, but as that happens, we expect other parts of the world to pick up. So the overall effect will be, fairly sort of mild downturn, then possibly another uptick in 4 or 5 years' time. As I said, we're confident about 2021. This sort of 2022 period onwards is obviously the more uncertain area of the forecast. But yeah, this year we should see stimulus, and that's important because if public construction tends to be infrastructure, you don't really get much public housing and not much public non-residential. So if the public sector spends money on construction, it's roads and to a lesser extent railways and other infrastructure. And that's the one that really, really matters for construction equipment sales, and particularly for large construction equipment sales. So stimulus spending around the world should be good for this industry. We are seeing very strong forward orders in the industry. The analysis I started with, looking at quarterly sales, there are a couple of companies within that group that report order intake. It's not that many. They represent about 15% of the revenues of the international OEMs, but we're seeing book-to-bill ratios in the last 2 quarters that we've never seen before. It's normally about 1, but it's gone from 1.25 in the 4th quarter last year to sort of 1.35 this quarter. So it is heading up. Great to have strong forward orders. It certainly points to, as many things do, to this idea that we'll get record global sales. But clearly, with that very high demand is the issue of what's happening in supply chains and what's happening with lead times. I think the first point to make is, throughout history, in the 2018-2019 peak and previously in the mid-2000s, when we've seen demand this high, we have seen issues in supply chains. There are some things that tend to be more stressed than others. It can be hydraulic components quite a lot of the time, but it can also be quite odd things. I mean, in the mid-2000s, I remember everyone saying we can't find big tires for our dump trucks. So it can be a variety of things, and that always seems to kick in when global volumes get above about 1 million units per year. In addition to that, you obviously come off a very, very disrupted year in 2020, when all the heavy industries and everything down the supply chain ramped down. And heavy industry does not come back on just like turning a light on. It does take time. So that is obviously exacerbating the problem. Also exacerbating the problem is the fact that, from, starting about a year ago, everybody in the industry tried to empty out their inventories. Of course, they're going to do that. That's the right thing to do. You need to look at cash flow in times of difficulty. So you want to sell your inventory. But the problem is with all those pipelines emptied out, with it being difficult to build new machines, we are seeing this this situation where the industry just really is struggling to meet demand. I feel it's a general problem at the moment, but I think one of the points is it only takes one thing not to be available for production to be slowed down. It doesn't matter if it's a major component or if it's a nut and a bolt. If you can't complete your machine, you can't sell it. The positive is, of course, it is helpful for everyone's pricing, but I think it's probably reached a point where people would say, yes, actually the problem of not being able to meet our customers' orders is bigger than the issue of when we do sell them, we sell at a good price. So that's the issue for this year, I feel, and it may drag on into next year. I think the issue about 2022 is, what will the world look like when all the support for businesses and job protection that's going on around the world has tapered away? Businesses will have to stand on their own 2 feet, and it really kind of remains to be seen how strong the economy will be. The obvious concerns are unemployment. There is when things like sort of the restaurant and travel business really closed down a year ago, there was a certain feeling that people who were laid off, particularly in North America, this was the prevailing view that those job losses would be temporary. The world would come out of COVID and people would want to, fly places, eat out and have a beer again. I'm sure they will, but I think there are now questions about whether those job losses are temporary or permanent. So that's going to be an issue, particularly if businesses start to fail as the protection support has tapered away. And the other thing is obviously, putting that level of job protection in place has been astoundingly expensive. Government debt, I think, will be a concern. And that, in order to deal with that, government's going to have to cut spending, they're going to have to raise taxation, and they're also going to have to wait a little bit and inflate the debt away. That's always, those 3 things are the only things that governments can do. And that will obviously lead to a weaker economic environment. And it's the sort of the economic environment and the strength that construction equipment sales ultimately flow from. The positive, of course, is that interest rates will remain super low for years to come, I believe, in response to that. There will be stimulus spending, we feel. There's a question of how well it will be done and how long it will last. I'm not going to say too much on that other than that it is difficult. I mean, if you look at what happened 10 years ago, China spent a phenomenal amount of money, but it did it too quickly, and then it kind of fell off a cliff. So you had this boom and bust situation. And everywhere else in the world talked stimulus, but frankly didn't do any really, and very quickly went from what the politicians called stimulus mode to austerity. That happened too quickly. So you had that sort of period of 5 years in the early 2010s where economic growth was very, very weak. The other thing I would like to say, and obviously you can't really give a webinar these days without using the phrase new normal, is that some of these things will stick. Many of the people I'm sure listening will consider themselves business travellers, and having conducted commerce for the last year down a webcam, I think you really have to question whether we will travel as much as we used to. Certainly hope we'll travel some and see each other at trade shows and conferences. But I think the realization that we can do it digitally means that we will do more of it digitally, and we won't have the cost and inconvenience of travel. And that obviously impacts on you know, ultimately on the built environment. We don't need airports, hotels and restaurants, and in this industry bars quite as much as we did in the past. Similarly, this thing of so many white collars working from home, you know, for many people it's nice, it's convenient, and it saves them money on a commute. And for many companies, it saves them a fortune on an expensive city centre location. I think it would be nice for us to see our colleagues again a little bit, but we maybe won't be back in our offices 5 days a week. So again, that impacts the need for built infrastructure like offices and commuter infrastructure. The point about that is if you don't need them as much, there's less construction, therefore there's less construction equipment sold. In terms of what off-highway research covers, that's not, that sort of non-residential construction is not the biggest thing in the world. It doesn't require that much earth-moving equipment. It's more about tower cranes and hoists and to a certain extent piling equipment. So it may not show up that much in our kind of numbers, but I think in terms of sort of the wider construction industry, it is something to be aware of and something to think about going forward. And the final thing I'd like to say is just about the global population of equipment. In this industry, it's something you have to estimate because there really isn't any requirement to either register new machines or register scrappage. So we build these population models by taking a view on what the average life of the different equipment types is. And what you see, as I said, with this prolonged peak that we've seen, or that we expect to see, we expect global equipment populations to rise to kind of quite a high level. There are some numbers in the next slide, but throughout the 2010s, the world seemed to get by with about 6.1, 6.2 million pieces of construction equipment. In the last couple of years, that's risen to about 7 million, and we see it rising further to about 8 million. So just to kind of make the point that with that extended peak, you do actually see a surge in the population. That's not necessarily a bad thing. The population of equipment you would expect to grow over time as more things mechanise and manual labour is replaced. I think the problem is that when it happens relatively quickly, you can have a situation where construction activity might fall away quite quickly. And then you're left with quite a lot of young machines in any given market or in the world, which are suddenly underutilized. And that becomes a big barrier to the sale of new machines. It's obviously a biggest threat in the countries where you've had high sales for a long time. And, you know, the obvious comparison to draw, the obvious one to flag up there is China. But it is happening to some extent in other countries as well. You know, I don't think it's necessarily anything you can do a lot about or can manage, other than if you are an OEM, to try and manage the used equipment channels as much as you can and get used equipment sold out of market. But, you know, it is something I would flag up as a bit of a concern going forward. So with that, I'm going to take a breath and take a sip of water, and we'll have a look at the chat channel and see what questions you have. If something occurs to you after this event, I should say the slides will be available, but you can contact me directly, or you can follow us on LinkedIn and a few other places as well. So with that, I'm going to stop sharing. I am going to fire up the video and see if there are any questions in the chat channel.
Thanks very much, Chris. That was, as always, a very comprehensive canter through the world of construction equipment. I always learn something new, even though I've been working with you and with David, your predecessor, for too many years, more years than I care to remember. It's always informative, and I can see why so much of the industry relies on off-highway to get all their statistics and market analysis. Can't see anything in the chat box yet. If anybody has got a question, we'll just run on a few more minutes to ask them. But just something that's coming across my desk a lot, Chris, well, far too much really with all the government, is how do you see the impact of non-fossil fuel engines impacting manufacturing? I mean, at the moment it looks like it's a case of sort of aspiration over achievability. Lots of people have lots of ideas, but they don't seem particularly scalable at the moment. And when you take into account the infrastructure on the job site, what impact do you see that having in the short term?
Yeah, good question, and one that's popped up simultaneously in the chat channel.
How is it?
I think at the moment, well, there obviously been a lot of electric machines sold in recent years, shown in recent years at trade shows, but I think it's only in the last couple of years that you've really sort of seen them in commercial production. So they are coming out, and they are sort of starting to be seen in the marketplace. We don't follow them directly. We believe the numbers are still sort of quite small, probably around about 0.1% of the global market. So, you know, in the region of 1,000-ish units per year at the moment. Having said that, you know, the sales of these machines will only go one way. You'll see, I'm sure, battery technology improve and get a lot cheaper as it has done historically. And at the same time, governments around the world are less and less keen on diesel engines because of air quality issues, and probably unfairly, I would say, about their perception of diesel engines being dirty, which is not so much the case these days, especially with stage 5 coming in. But nevertheless, diesel is also a fossil fuel. So I think to a certain extent it's gonna have an uphill battle. So yeah, I'm sure electrical equipment will come, and yeah, probably electric initially. I know there's some interest in hydrogen at the moment. I mean, don't have the technical know-how to sort of understand why hydrogen would be better than electric machines, but I think the point is around that is not just the machine, it's the infrastructure that's required to support it. And you can buy an electric mini excavator, and you can probably find a way of plugging it in at night right now. If you buy a hydrogen powered machine, I'm not really sure where you take it to fill up. So again, you know, I expect that will come with time, but at the moment, that's the lack of infrastructure is obviously going to be a barrier. We see electric machines featuring the most in the compact sector. So anything up to about 10 tons is probably ripe for electrification. I think it just kind of relies to a certain extent on how the economics of that machine sort of shift. I think it also depends on the manufacturers making the case for total cost of ownership for electric machines, because there should inherently be less maintenance with an electric machine, particularly if you start to get machines which are fully electric. So at the moment, it's the diesel engine replaced by an electric motor, and it's driving a hydraulic system. If you can take out the hydraulic system and move the boom or whatever with electric actuators, you're obviously taking out a major component there in terms of the hydraulic pump and all the valves and whatnot that are associated. And you're obviously taking out another system that can be quite needy in terms of not just day-to-day maintenance of filters and checking the quality of the hydraulic fluid, but also replacing burst hoses and all those other painful things. So yes, I mean, I think the future for electric equipment, particularly in the compact sector, is bright, but it's obviously at a very, very early stage, and is probably something where, as often in the off-highway world, the lead will actually come from the on-highway world, and we'll see it in things like trucks and buses first, and some of the enabling technology will kind of trickle down to us because of the inherent lower volumes in construction equipment.
Okay, great. Next one from Richard Tomlinson says, do you have any production information on production in South Korea?
Yes, we do. you obviously got 3 major OEMs there in Doosan, Hyundai and Volvo, mostly producing mini excavators, crawler excavators and some wheel loaders, and also a fair few forklifts as well if you're interested in that sort of thing. I don't have them at my fingertips, but if Richard would like to get in contact, I can fill in some details and point him to some sources. I see there's a question from Connor Woolley as well. Do your figures include those pieces of equipment sold into the quarrying and mining industry? Yes, they do. We include dump trucks in our figures, and we include all sizes of wheel loaders and excavators up to those very high levels of big sizes that are typically sold in those industries. In terms of making a difference in the volume picture, you kind of tend not to see the difference if there's a sudden spike in quarrying and mining equipment, because they're sold in relatively few numbers. I mean, the market for mining excavators is 500 to 1,000 machines per year worldwide, out of a market of several 100,000. But obviously, if you're in that market, it is a very interesting area, and they're the very, very high value pieces of equipment. So yes, that would be included, but any changes in mining and quarrying demand would not necessarily sort of show up as a spike in one of our graphs.
Okay, right, well, we're up to and over time now, and there are no more questions in the chat box. As Chris said, this will be going up on the CEA website, and we'll send a PDF copy of Chris's slides out to everybody who's registered for the webinar today. So thank you very much, Chris, as always. And I know you'll be offline to take some questions from participants who haven't mastered the art of the chat box. All that remains for me to do now is to remind you that the next CEA Power Hour is the 23rd of June. And really following on from what we were talking about just now about non-fossil fuel equipment, we've got Alex Woodrow, who's Managing Director of Nib Gomezano and Partners, who are analysts and researchers in the internal combustion engine, and also looking at alternate fuels now. We'll be sending out a registration link, but please put that in your diary. So more of a deep dive into the technical aspects of the road to net zero, and hope you'll join us. So thank you very much, everybody, for coming, and back to your next Zoom or your rest of your day, and see you in June. Thanks. Bye.